Market continues to rally. Hello, everyone, and welcome again to the Smart Investor Podcast, where smart investors make up to the minute price analysis and market information. Okay, in this edition of the podcast, we're going to take a look at this massive rally we are seeing in the stock market. Everywhere I go, and people are speaking about this rally. The articles are speaking about this rally and where will we be going. Are we going up to 21,000, 22,000? I saw an article the other day about the Dow 30,000. So we're going to take a look at what exactly is happening in the markets. For those of you who are listening, you can see a video analysis of the market on smartinvestorcentral.com. Okay, so let's get started. The Dow yesterday, which was Wednesday, closed at 20,762, and we have seen quite a significant rally from that spike low that was made back in December. Now, I would say we're reaching a point where we're getting very euphoric in the market, and we're seeing where the market could start to go parabolic. What that means is that it is, well, not could, it's going now almost straight up, and every time we see that type of market formation, it could mean that we're at a point where we could stall. And it definitely gives me some pause at this point in time, because the euphoria in the market is very, very high. Just listen to CNBC or listen to Bloomberg. Everyone is speaking about buying stocks and how far this rally can go. When I attend cocktail parties, it's all about the markets and how high it can go. And I'm seeing regular investors jump in at this point in time, and that is, to me at least, definitely a sign to be very cautious in this market, because we could see a quick turnaround. Remember that this market has been rallying ever since 2009, so we're due for a pullback at some point in time. Now, folks also, on the contrarian side, there are folks who say that this market is definitely nearing a top, and are asking about short in the market. Rule number one when it comes to the market: do not short a market in an uptrend. That is definitely a sure sign to lose money. If you are long stocks, it could be prudent to take some stocks off of the table, because I solidly believe that obviously this market rally cannot last forever. So it is prudent to take some stocks off the table, but that's different from shorting. Shorting is you're taking a new position and expecting the market to go down. I would definitely not advise you to go short this market at this point in time, because we're not really seeing evidence that a short position would be a good thing. Now, the Dow, looking at the technical levels, is at 20,763. The next area of of psychological resistance is at that 21,000 level, and I suspect the market may try to reach that point. We're currently above the monthly pivot numbers, R2 pivot numbers, and anytime the market's above those monthly numbers, it can tell me that probably we are nearing a top. At least for this month of February, we could see a slight pullback in the market at this point in time on the Dow. Taking a look at the S&P 500, similar situation. Market is rallying fairly strongly. It's at 2,362 on the S&P 500. We're obviously at new highs in the market, so the next area of psychological resistance is up at this 2400 level. Looking at the overseas markets and we have seen some fairly good rallies in Europe. Looking at the German DAX, we see that the market is firing on all cylinders, but still this market has not reached the high that was made in 2015, the high of 12,390.75. We're still below that level at 11,998, just short of the 12,000 level. So that could bring some pause, and we could see some resistance at this previous high in the German DAX. That's definitely a level you should be paying attention to. The FTSE in England, and this market has been very volatile ever since that Brexit vote, but we are currently at the 7,302. Notice that the previous highs of 6,950 and 7,122 has been breached, and that is a good sign for the FTSE. But we need to see the market go above that 7,500 level for it to really show even more bullish signs. Because at this level, we have seen in the past where the market can turn around quickly anywhere up at these levels. Okay, so generally stocks, be very careful. I definitely would not advise putting on new long-term positions in the stock market at this point in time, because I believe we are due for a pullback. Now, how pullbacks work is that you could have a temporary pullback or a long-term top that is put in place, and I believe that the market is at a point that we could start to see a longer-term top and a significant sell-off in the markets that could last for 2, maybe even 3 years, depending on how hard stocks fall. So that's what I'm seeing in the forecast. Taking a look at the US dollar index, US dollar is currently at, the index is at 101.36. Over the last couple of months, the US dollar hasn't been doing anything. Actually, the US dollar formation looks like it wants to put in a longer term top. This pattern has not been confirmed as yet. You technicians call it a head and shoulders pattern. It hasn't been confirmed. If we break below this 99 level on the US dollar index, that will confirm this head and shoulders top. If we close above the 102 level, the next area of resistance will be just below 104 on the US dollar index. So the dollar, like the S&P 500, has been in a bull market ever since 2000. We saw a bottom in 2008. Early 2008, we got a bottom. That's when everyone was saying that the dollar was worthless, and we saw a rally in the dollar, and we could see a topping formation in the dollar over the next couple of weeks to months. It's something that we are going to pay attention to. Looking at the gold market, gold is in what I would call no man's land at this point in time. The trend is neither up or down. We're moving almost sideways. Last year we saw some promise that this market could have put in a longer term top. That analysis, sorry, a longer term bottom. That analysis is still pretty sound, but the market is not showing any definitive trends at this point in time. A similar situation or similar setup with the silver market. Again, it's not trending down, it's not really trending up. We're in no man's land, and if we get a break above that $19 level in silver, that would be very bullish for this market, and we could even look at putting on some long positions. Taking a look at the other commodities, we see that that the crude oil market is meandering between just below this $54 level and has been very quiet over the last couple of months. Commodities over the last couple of months have been fairly choppy, with just copper really leading the way and leading the charge upwards. But the other commodities has been basing, what I call putting in. Most of them have been putting in a bottom and it's steadily moving up, and it's based on past, and it's my belief that we are going to see a significant rally in the commodity complex, especially if we see the US dollar top out. If we see the US dollar put in a longer term top, that will be very bullish for a number of these commodities that are showing signs that they want to really come to life. For example, the crude oil market, if we get a break above 56, that would be very bullish for the oil market. Looking at the agricultural commodities, we're seeing a pullback in soybean complex and the wheat complex. But as for example, the wheat market has been basing, and it's looking like it's coming to life. We got a break above that 45 level, and that is very good for the wheat market. So in this market environment where stocks are leading the way, because stocks are really outperforming everything, it's time that investors, or it will be prudent if investors start to look around and to see what other investments there are. I speak with a number of investors, and most of them, most folks are led to believe that they are diversified, and that belief has been given to them by their financial advisor. But when you look at their different holdings, they may be involved with healthcare stocks, with technology stocks, with some financial stocks, etc. But what the common thread is that most of these holdings are in the stock market, and if we see a decline in the stock market, it normally will drag down all of these stocks, no matter what quality these stocks are. So, for example, in 2008, even some strong stocks saw 50, 60, 70% declines. And if we do put in a longer term top, we could see a significant sell off, and everything will be dragged down. So if you are holding a number of stocks and you think you are diversified, you are setting up yourself for a similar situation in 2008, where many folks thought they were diversified and lost a lot of money, because the market is like a drag. It takes everything down with it. You're not going to see a 40% correction in the Dow, and you're not going to see many stocks hold up under that downturn. So it is very prudent that you look at diversifying your portfolio, especially at these high levels. Investors must not get caught in the trap of the euphoria. That's how people lose money. They think the market will go up and up and up forever, and you get a environment where people just want to buy even more stocks at the top of the market. We see time and time again, cycle after cycle. If you'd like a free portfolio consultation to see if you are properly diversified, or want some more information on how to invest in different asset classes, or where to put money now that the stock market is probably putting in a top, you can go to smartinvestorcentral.com/consult. That's smartinvestorcentral.com/consult. Thank you very much for listening, and I hope you have a wonderful day.